Hello, everyone. Welcome to the 36th California Small Farm Conference. My name is Guido Lois. I'm a Communications and Events Manager with CAF, which stands for Community Alliance with Family Farmers. We have two amazing speakers today, but before we get into that, I just wanted to go over some logistics. Wanted to let you know first that this workshop is being recorded. We're going to upload it to YouTube later. And that if you have any questions for the speakers, you can always field them utilizing the Q&A feature at the bottom of your screen. You'll be able to find it in your menu. If you don't see it, it's under those three dots which say more underneath. And if you have any comments, you can put them on the chat. We are trying to keep comments and questions separate, so you have a better chance to get your question answered if you put it utilizing the Q&A feature. Lastly, I wanted to thank our sponsors for making this happen. Funnily enough, our speakers are also part of our sponsors. So thank you, speakers and sponsors, for joining us today. And yeah, Regina, Allison, you can take it over now. Thank you so much for being here.
Great. Well, thank you. And thank you to everyone for joining us this morning. I'm Allison Papp, and this is Regina. We're with American AgCredit. We are a local farm credit office that works with financing for all types of farmers and ranchers. And we wanted to talk a little bit more in detail today about some financing considerations for beginning and small farmers. So I'm going to start a slideshow here. All right, can everyone see that okay?
Looks good.
All right, so the things that we really wanted to hit on today was to just give some kind of general reminders, general introduction around kind of business cycles and types of financing that you would normally see, our funding sources that you would normally see at different stages in the cycles, and talk a little bit more about some key vocabulary terms and things that are helpful when you're filling out loan applications or speaking with potential lenders, and talk a little bit more about the loan application process step by step, and then give a little bit more information about American AgCredit, about the farm credit system, and have plenty of time for questions and make sure that we're hitting on the topics that are most interesting to you. As Guido said earlier, if you do have questions, if you could put them in the Q&A box, that's especially helpful for us to help monitor to make sure that we're getting it, that they don't necessarily get buried in some of the chat comments, that we want to make sure that we're hitting on all the questions. So starting off, we wanted to just take an opportunity to kind of take a little bit step back and just talk about business cycles in general. That no matter what kind of business you're in, no matter the size or scope of the business, that it generally falls into kind of 5 different stages. That's really starting up with this sort of launch, this newly development stage, the growth stage, shakeout, maturity, and then we eventually start seeing declines. And the reason I wanted to bring this up and kind of start off with this kind of thought is that each of these stages have a little bit different place, or it's where it's more common to find specific funding sources. So in that launch stage, in that like startup stage, that's typically the highest risk stage. And so because a lot of businesses at that point have a little bit more uncertainty in their earnings, it's challenging for them to commit to a longer term repayment schedule. And so because of that, it's not as typical to find a traditional loan as their funding source. That typically people are looking for partners, they're looking for private investors, they're looking for something that's more grant funding or something that has a little bit more flexible repayment structure, something that isn't necessarily repaid through a standard monthly payment or standard, annual payment, something like that. And as the business continues to grow and develop and really has a lot more predictability in terms of what the business is generating and what the sales and those types of things with the business, that's where we start seeing a little bit more availability in terms of more traditional loans. So when we're talking about loans, what we're really talking about is a traditional source where it would be kind of that standard repayment schedule. And so as a consequence of that, it's not as common for lenders to be as aggressive with businesses in that like development stage and that launch or even into that growth phase, just because it is a little more challenging to look at and commit to a repayment schedule. So we'll talk a little bit more specific examples when you're in that early stage, that what we normally see is kind of business partners, private investors, kind of angel investors. We see crowdfunding with the different, sources of people looking for support through either something that's donation based or something that's a reward based crowdfunding. There are some specialized lending programs that Farm Credit has some specialized lending programs geared toward beginning farmers. There's Farm Service Agency has some specialized lending programs that's through the USDA that's geared toward people with a little bit lower amount of farm experience. USDA usually looks for, a couple years of farming experience for their lending programs. CDFIs are another place that's a specialized lending source, and that's a community development funding institution. And those are typically lenders that are focused on kind of that specialized niche for something that's in more of that like growth phase, or something that maybe has only been in business or only has for a shorter time, or maybe only has like a year of historical earnings, that kind of thing. Whereas, a more traditional lender is going to ask for multiple years of historical information as part of the loan application. And I also wanted to kind of take the opportunity to kind of take another step back and make sure that when we're talking about loans and we're talking about the credit market in general, there's some specific classifications that that are really going to direct to that funding source. That some of those classifications are really start off in at the highest level between a consumer loan and a commercial loan. So a consumer loan is where the funds are really being used to support you individually and to support your just daily living. So things like your home loan, your car loan, your credit cards, all of that is consumer debt because it's really supporting your daily living activities. A commercial loan is a loan that's really used to support a business activity or an income generating activity. So the commercial loan market is most applicable for things like farm loans or loans for like rental property, things that are really that are geared toward business activity. And the reason I bring this up is that just to make sure that when you are talking about potentially applying for a loan, that you have a clear understanding of the type of loan you're asking for, because there are two separate credit markets. So in that consumer loan, when you're talking about like your home loan financing, that's going to be different types of loans available as far as like what the interest rates are, how long of a term, how much of an advance rate they'll give, and we'll go over all of these terms as the presentation goes on. But kind of this idea of how much money the lender will lend against the asset, how long they'll lend the money for, is going to be a little different than what you see in the commercial market. And the commercial market in general is always going to be a little more conservative. So for example, it's common to have, a 30-year home loan, whereas in the commercial market, it's a little more common to have something that's maybe 20 or potentially 25 years, that kind of thing. So we've talked a lot about sort of this different types of funding sources, different credit markets, and, kind of ideas around am I ready to really apply for a loan? Then there's a few questions to just really kind of make sure that the applicants thought through during this process. Things like, is this purchase that I'm making that I'm going to borrow money for, is it going to generate enough income to repay? Do I have the information that I'm going to need? Do I have the balance sheet information available? How is this going to impact my future business if I devote a lot of resources to this particular asset? Is it going to impact me from continuing to run my business? So as we're kind of thinking through these things and recognizing that a loan is the right instrument, and it's not necessarily, what's really needed is investment capital, but it really is at a point where a repayment schedule is reasonable for the business and that this asset is reasonable for the business. That's really when it's time to start getting some information together and start having some conversations with the lender. So we wanted to talk a little bit about decoding this loan application process. So Regina, I'll let you take over from here.
Perfect. Yeah. So as Allison mentioned, we want to look at what your risk is in your business. It's really important for you to understand that first. And one way to kind of look at getting a loan with the lender is you're entering into a business deal with us. So we want to take a look and identify your risk and any potential risk. And we want to make sure you understand it. We want to make sure we understand it. So we're going to kind of start to go into what we look at and how you can better help show your story, understand your numbers, and what kind of ratios we're going to be looking at. So one of the first things we kind of look at is the 5 C's of credit to help kind of identify this risk. So a lot of lenders will look at these 5 C's of credit in different capacities, and we'll go into detail for each one here, but just to run through them really quickly. Character, that's really going to be, do you know your operation? Are you able to pay back the loan? Capacity, that's going to be your repayment capacity to pay the loan off and run your operation. Capital, and again, we'll go into all of these in better detail, but capital is going to be looking at your assets and your liquidity. Collateral, that's typically what we're going to secure the loan with. So if you're purchasing real estate, a lot of times we will secure that real estate, that loan to that real estate. And then conditions can vary throughout the loan, but say if you're purchasing that real estate again and you're in a flood zone, we might have a condition on there that you might need flood insurance. We're going to go into a little bit more detail here. So that first one for character, one way that we can actually measure character is your credit score. So we all know credit scores can be a little bit finicky and they can fluctuate, but a couple key points here, really kind of, you can see on this chart, payment history, debt level, and time in the bureau, that makes up the majority of your credit score. So kind of some best practices with that, avoid some high credit balances, make your payments on time. Kind of going back to that high credit balances, if you have a $20,000 limit, while it's there for you to use it, one thing we might look at is, are you using up that 20,000 every single month, or are you, drawing it down and paying it back as you can? And then obviously we all want to avoid tax liens, collections, bankruptcies. That kind of shows you not, basing everything off of a past mistake, but it is a way for us to be able to see what your repayment ability is as we're going into a business deal essentially with you. And then with that, of course, the negative impact, late payments, portions of balance too high, it's kind of what I mentioned. If you have a $20,000 limit, we don't want to see you utilizing and at your limit all throughout the month, because then that might show some distress that you're not able to pay that down. Lack of credit history, opening too many accounts at one time. Why are you opening up a bunch of accounts? You're having a bunch of inquiries at once. Are you going to a bunch of different lenders to try and find someone to finance something? collections, bankruptcy, foreclosures, anything of that nature. Those will all show up on your credit report. You can take a look at.
So another part of this loan application process, that Regina mentioned, kind of going through these 5 C's and kind of talking about that character piece in particular, the credit score is a key element because it does really get utilized in a lot of database decisions. And so if a lot of lenders are utilizing like scorecards, or they're utilizing, more data for their credit decisions, the credit score is going to be a huge part of impacting the credit decision. And when I say credit decision, what I really mean is, will the lender do the loan, yes or no? That's really kind of the bottom line credit decision that they're making. But another piece of that is, kind of going beyond the credit score, is really this idea of being able to describe your loan or describe your business to a lender. And you want to make sure that you're describing the business in a way that you can paint the picture to the lender, really what the business looks like, what the goals of the business are, and what kind of that performance of the business are. And the way that is a very helpful way to paint that picture is to provide a business plan. So the business plan doesn't need to be long. It doesn't need to be like a kind of like a huge business plan, but it really can point out some key elements to make sure that your business, the story of your business, is really being described well to a lender. So things like, what does success look like? What are you doing with your business? Are you trying to are you looking at trying to generate a certain amount of income? Are you looking at trying to generate enough income to keep the business going plus all your living expenses? Are you looking at, generating a certain amount of product? Are you looking at potentially having something that's a little bit more of a mission-based business, where you're trying to provide a certain amount of product to, fulfill a certain mission? And those things are all helpful for a lender to really understand what the scope of the business really looks like. And then talking about the strategy and the marketing plan, the management summary, this idea of there's an outlet for your crop, or there's an outlet for your product, and that you have a sales plan, and that, there's this idea of once the product is produced, that there's a way to generate income from that production, and that can be described. And then the financial analysis and projections is really looking at the business in terms of making sure that the lender understands what assumptions you're making when you're going through your finances. So for example, if you have a winery, if you're making projections on what the earning ability of your winery is, are you assuming that you're going to be able to sell every bottle at, $200 a bottle? So that may not be a very reliable assumption when you're making a sales plan, and that you may need to really understand of like, okay, what is a reliable assumption? What is something that's something that I can really say that I feel confident that this business is going to be able to generate this type of income and have this type of activity. So there's a lot of great online resources to help walk you through these process. USDA has a great resource with their New Farms web portal, and they have a discovery tool. They have a lot of online resources to really help you walk through these and think through these individual parts of the business plan. The UC Agriculture and Natural Resources has some great resources, and they have a lot of resources specifically for businesses that are a little bit more based on direct to consumer sales, or kind of that agritourism model. They have some great resources for that. Small Business Administration also has some great resources around helping you draft a business plan, or just giving you some templates to kind of start thinking through things and putting out some bullet points to make sure that you do have a clear understanding of what that looks like. And then there's other groups like Kitchen Table Consultants that will come and meet with you one-on-one and kind of help you construct these business plans to make sure that that what you're doing is really something that's has long-term sustainability and that's reasonable, and that when you are presenting your plan to a lender, that you're confident that taking on the debt that you're asking for is going to be something that will ultimately be an advantage to your business, and not something that will really be a challenge to maintain or will cripple the business from continuing to operate.
And I'll just jump in here really quickly before you finish this last slide, Allison, because there are some questions in the Q&A, and I think Allison answered most of them. Someone had some questions about some resources, so those are some great resources to get those templates. A lot of times if you're working with a lender, we might have a template we can provide as well. And then there's a few questions about, if you're applying for a business as a standalone business and so you don't have a credit score, that's where that business plan is going to come in handy. We're also going to get into some projections. There are some questions around, if you're starting up a business, we understand that, or we understand you might have been in a certain, maybe you had a vineyard, you're looking to go over to cattle, or your vineyard operation looks different. So we'll get into a little bit more of that too on how you can provide projections and cash flow. If you haven't been in farming, or if your farming looks different than it did previously. So we'll get into a little bit more of that too, to answer your questions a little more in depth there.
So, yeah, and then just as the business planning is really it oftentimes is a little bit higher level, that it's really kind of painting the overall vision of the business and the overall strategy of the business. But the lenders are often going to be asking a little bit more specific questions that's really kind of helping answer the question of, if you do borrow this amount of money, what's the likelihood of being able to repay it? And if for whatever reason the projections don't work out, does the business have enough strength as far as assets that it could refinance or sell, or do something to really help support repayment of this debt that the business is potentially taking on? So that's where the lender will oftentimes start asking a little bit more detailed questions around your cash position, around your overall debt position, and things around, what your vision for going forward is, what the budget is. And so we wanted to kind of go through some of the standard kind of lending vocabulary, or kind of standard jargon that lenders will often use, that really dig into these questions of, what kind of cash position do you have? What kind of asset base do you have? How much income are you generating? What are you projecting next year or the following year to look like? Those kinds of things.
Perfect. So kind of diving into that and kind of going back, relating this back to our 5 C's. So we're going to talk a little bit more in depth here now on financial statements. So first one being balance sheet. And this is going to really relate back to that capital C in the 5 C's of character. So what is a balance sheet? A balance sheet is basically a snapshot of your business, or it could be a personal financial situation, a snapshot in a point in time of everything you own and everything owed on it. So it's really made up of 3 major components. You're going to have your assets. That's going to be everything that you own and has value. And then the liability. So basically any debt that you have associated with those assets. And then that brings you to your net worth, or your owner's equity, which is basically the dollar difference of those assets and the liabilities owed on them. So here's kind of just there's so many different versions of balance sheets out there. Again, those resources we shared earlier, you can even just Google balance sheet. You can have some templates. The one on the right-hand side is one that we will send out a lot to clients, but they all are going to look essentially the same. You're going to always have your assets on the left-hand side, typically broken out into current assets and long-term assets. And then on the right-hand side, you're going to have all your liabilities that correspond with those current assets. You're going to have your current liabilities, same with long-term liabilities. And we'll kind of go into the next slide, which will go into a little bit more detail of that. So Current assets are essentially, one way to look at it is anything that you could liquidate easily or convert to cash within that operating cycle. So checking, savings, marketable security, accounts receivable money you're going to be receiving within the next year, prop inventory. And so then that leaves any non-current assets or things that you can't move or liquidate as easily. So typically you're looking at breeding livestock, machinery, equipment. You have retirement accounts you can't touch until a certain age. And then vehicles, real estate, things that are kind of longer term assets there. And then on the flip side, you're going to have your corresponding liabilities. So current liabilities, if you have operating loans that you kind of help to get your crop up and running, that kind of offsets your crop income, anything basically owe within the next 12 months. And then the non-current liabilities, those are going to be your mortgage payment, your mortgages, things that correspond with those longer term assets. And then there's so many different ratios we can go into, and we'll kind of go over these quickly here. There's a couple different ratios that you should just kind of know for yourself over time that are just kind of good practices to go through, and some of these different lenders will look at it at certain times. So we can look at your liquidity measurement. So working capital, again, current assets, we're looking at what can you essentially liquidate quickly. Or for yourself, if you find yourself in a pickle one year, do you have enough cash on hand to kind of carry you through? So one way to kind of look at that is just taking your current assets less your current liabilities, and that gives you what your working capital is. Same with another liquidity ratio is your current ratio, which is essentially your current assets divided by your current liabilities. And then kind of going into some more leverage ratios from your balance sheet, that net worth again. So basically, if you were to take all of your assets and minus everything you owe on them, all of your liabilities, what is your net worth? And then some different owner's equity ratios that kind of help with that net worth, and understanding your net worth is taking your net worth by your total assets, or your debt to equity is essentially taking the flip end of that. So what are your total liabilities divided by your net worth? And then kind of going a little bit more into the next C of credit, which is capacity. So looking at what your income looks like. So we were just looking at your balance sheet. That's essentially all your assets, your capital. Now looking at what does your income look like. So a couple ways we can do that. Looking at your capacity, your repayment ratio is a tax return, and then also an income statement. So we also understand, sometimes tax returns last year is not a good representation. Mother Nature took its course on your operation. You're starting new. So that's where we'll kind of get into, a tax return is a great way, similar to credit score, but it's not the end all be all. We can look at an income statement, a projection. So kind of some vocabulary around that income statement, and understanding that is your income, that's of course your revenue that you're making. Cost of goods sold, you might have heard it thrown around as COGS. One way to kind of look at that is any direct costs. So let's say you are making ice cream. Your cost of goods directly to that is your cream, your milk, your sugar. That gives you your margin. So basically your gross profit. So that's really good to understand your direct inputs and your direct costs as you're building your product. And then of course you have all of your overhead expenses. So any rents, accounting fees, taxes, everything else that kind of comes with running a business. And then once you minus your cost of goods, all your overhead expenses, you'll get your net income. And one ratio that we do kind of look at a lot, and we look at your repayment margin. So we want to basically ensure that you can cover all of your obligations, all of your expenses, all your taxes. A lot of times we like to make sure, or not a lot of times, we always like to make sure you can also cover any living expenses, or are you still building capital in your business? So sometimes we have ratios around that of making sure that you can cover your debt 100%, and then you have a reserve left over for emergency or building that additional capital. So here's just kind of another quick snapshot. Again, there's a lot of different forms out there you can use. They're all kind of pretty similar here of taking down all your expenses, your estimated costs. You can take down historical. It's a great place to start, but again, we understand it's not going to always be the case. So you can always look forward to projecting months or years out. So here we go. So kind of like I mentioned, historical or projected, it kind of depends on your business, your operation. But one thing that is important is understanding your income and your expenses, either per acreage or per head. So while say you have a vineyard and you have one block of acreage planted to a certain varietal, while it's good to have diversity if you have multiple varietals, in certain years you might cover one varietal that didn't do so well or got hit by some heat. It's always good to look at your per acres or your per head to understand truly if that specific acreage or, certain cattle are producing, so that if your business is profitable. And if it's not profitable in the area, you can really dig back into that certain acreage that maybe isn't producing like it should be, or maybe it's costing more than it should be. So kind of going into debt servicing, living expenses, again, it's really good to understand your operation and what that looks like. And that's where that calculating per unit really helps. And really being honest with yourself of what your expenses are and where you think your expenses are going to be. Just because we look at historical doesn't mean that that's going to always be the case. So it's always good to look at this as a realistic representation of where you think your business at and understanding it. We're going to look at this too. And if and you planned ahead, or that something's going to be a little bit different, sharing that information with your lender is really valuable information.
So we've been talking quite a bit around utilizing, kind of ratios and really digging into the numbers of your business in order to really tell the story to a lender, or to really provide that information to a lender that helps give a bigger picture view of your business. And it really sounds like, a lot of this tracking and a lot of this work is all for the benefit of the lender. But really, this information is very helpful for you as the owner, or you as the manager of the business, to really have a key understanding of things that are happening throughout the operating cycle, to help make sure that you're meeting the goals, and that you're on the right track, and that you're not necessarily encountering kind of unexpected issues, because you have these milestones, or you have these tracking points. Making sure that you're keenly aware of the current prices and the commodity trends to help you plan that kind of thing, and that really understanding how the sales cycle works within your business, and how you're capturing that information, and how you're really being able to set up things to help the business be as predictable as possible going forward, is key for you to help make business decisions around if you want to expand, or if you want to take on additional debt, or if there's other aspects of the business that you're looking at maybe moving into, that really having these metrics, and having these sort of ways that you can have an objective way to really measure the performance of the business, is really critical in you as the owner, and you as the manager, of making some decisions. And that's where this whole concept of key performance indicators come in, or these kind of KPIs. And I mean, there's thousands of indicators that can be helpful, but things, if you're tracking things like your net profit, your sales per acre, your current ratio, your gross margin, some of the things that Regina talked about, that like, if you're in her ice cream example, if you're spending a certain amount of money on all of the inputs it takes for you to make your ice cream, are you selling it at a reasonable price where you can continue to operate that business? You know, that kind of thing. Um, what kind of sales are you getting for every dollar that you put into an asset? Or what kind of sales are you getting for every dollar that you're borrowing? You know, how fast are you turning your inventory? All of these are examples of performance indicators that are really helpful for you as the manager to not only be able to describe your business to a lender, but really for you to understand your business and to manage your business. And so really having some of these tools in place and around, you know, tracking the income, having some budgeting basics, and really setting up a place where you can continue to track the the performance of the business, it does help provide that data for you to set up these key performance indicators that do help with the decision making going forward. So we've talked a lot about kind of that initial piece of, okay, when you're asking for a loan or when you're looking at potentially borrowing money, there's a lot of information gathering and a lot of really translating the work of the business um, into a number and into something that's like an objective number that really can be understood by anyone. But then there's also the piece that when the lender responds and provides information about a potential loan, there's some key things to really consider to make sure that you understand that, you know, are you clear about the interest rates and the fees? Are there any concerns about the repayment schedule? Like, are you working in a highly seasonal business, but you're on a monthly payment? Is that going to be something that is going to be sustainable for the business? Are there any surprises with the loan structure of who's borrowing the money or who's required to sign on behalf of the money? What are the reporting requirements? And reporting requirements are generally things like, you know, do you have to provide annual financial information, that kind of thing? And that's a very common requirement, and most lenders will have some sort of ongoing reporting requirement, but it is key to understand what it is, because you don't want to end up being in violation of, you know, the loan covenants, that if you didn't know that you needed to provide that information, or that it's a surprise that you're being asked to provide that information. Are there any other covenants, any other questions? So those are some, you know, kind of key things when you're talking about you know, reviewing a potential loan proposal or reviewing an idea of a loan. So I want to take a quick kind of stop point here. I know there were a couple questions that came in. One of them came in about grant funding. There are a variety of grants available, and they're typically you see a lot of grants coming in funded through the USDA. So we're those grants are usually for kind of specific purposes. The Natural Resource Conservation Service often has grant funds available for things around like resource management, like, you know, erosion control or healthy soils, that kind of thing. There can be some grant funding available for um, improving efficiency of machinery and equipment, that kind of thing. We as Farm Credit at American AgCredit don't have any sort of grants available, and those are typically administered under either government programs, or sometimes some nonprofits will have some grants available to help support you know, beginning and small farmers or people in that sort of like startup, you know, that sort of like launch phase of their business. There are some grant funds available for that. And the same kind of logic that we're talking about of reviewing a loan proposal is also key when you're thinking of applying for a grant, that you want to make sure that you understand what the requirements of the grant are, and that also if you understand that whether it's they'll fund you or if it's a reimbursement grant. A lot of the grants are reimbursement grants where you would, you know, purchase whatever equipment or make the purchases that you're being funded for, and then it comes back and reimburses you later. So in order to participate in the program, you would need to be able to, fund that initial purchase. So I don't know, Regina, am I missing any other questions, or did you see?
I think that got them all.
All right, well, we'll go ahead and move on to the next topic. So one of the things that we wanted to talk about was, kind of the role of the farm credit system. So the farm credit system is a nationwide system of agricultural cooperatives that, funds specifically farmers and ranchers, and limits their funding to just farmers and ranchers. So American AgCredit is a member of the farm credit system. And Regina, I'll let you take over this part.
Perfect. Yep. So we are part of the farm credit system. So there are multiple parts of the farm credit system. American AgCredit is just one of them. We all kind of specialize in certain areas. So on the map here, you can kind of see the green. That's the territories that we do cover and that we charter. The farm credit system covers the whole United States. So if you are not in our territory, there is a farm credit that is. If you go to farm credit locator, you can type in your zip code and it will take you to your closest lender. Same with if you're in our territory, if you type in your zip code, it will take you to our closest office and our contact information. And this is just a little bit of snapshot of some of our territory, highlights of how many employees we have, our kind of assets. A little outdated, but pretty similar to where we're at still here. And then with that, so we have some commodity diversity since we're in multiple states. So as you can kind of see here, vineyard and winery, I'm located in Northern California, Sonoma counties. We have a lot of vineyards and wineries, but we cover all ag sectors. So it's kind of a snapshot of what that looks like, and it really helps us withstand market pressure. So vineyards and wineries have a bad year, we're still in a stable position and able to still run effectively and pay out our cash patronage to our borrowers because we have a competitive advantage being across multiple commodities. As we know, especially in agriculture, there's a lot of fluctuations in the market due to weather in a certain area, or if there's a salmonella breakout. So having this commodity diversity really helps us at tough times and withstand different market pressures. And then, as we kind of mentioned a little bit already, we do partner with a lot of other organizations. Here's some financial organizations that we partner a lot with. So if you do come to us with a loan, and it's not something we can do, or we might have a better fit for you, get you a better rate elsewhere, we want to make sure we get you to the right spot. So Ag Director, great for equipment financing. We are partnering now with Rural First. We do have some limitations on residential loans, but this is where Rural First comes in with us because we know some rural residential properties, maybe a commercial residential lender won't touch. So Rural First has come in and they're able to do a lot of those country home loans, those smaller acreage homes with the house on it. And then we partner with USDA in a couple of programs, Farm Service Agency, we partner a lot. They have a lot of programs, especially for beginning farmers and trying to help you build that capital that, typical lenders might need. We'll work with them with some different programs there. And then we are on all of the social media platforms, as you can see here. American AgCredit. You can also visit our website at any time too. Our website's agloan.com. There's a lot of information that we've kind of gone over and specifically what kind of loans on there as well. So feel free to find us on social media, on our website, and then of course too, if you have any direct questions for Allison and I, our contact information, I believe, is on the next slide and on the the website when you registered. So feel free to reach out anytime with specific questions you might have for us, and we'd be happy to help you out or get you over to the right person.
So there were just a couple of questions that I noticed came in that I wanted to address real quickly. So one of them was about a recording of the webinar, and yes, a recording is going to be available. It should get posted within the next, few hours, but it should definitely be up by tomorrow to be able to review that. And I think we can make sure that the slides get sent out to all the participants too. So to make sure that everyone has access to the slides. There was another question that came in asking a little bit more about requirements for farm experience. There was a question that someone had some strong academic experience, but was still a beginning farmer, and what kind of loan programs would be available. And so in those types of situations, again, it's kind of really this question of what the needs of that business are, that what at American AgCredit we would be looking to see if throughout, if the business can generate the funds to be able to meet that repayment schedule, and that we don't necessarily have a hard line of a farm experience requirement, but that we would want to see that there is enough support and strength in order to keep that repayment schedule reasonable and to be able to meet those payments. The other piece that tends to be a little bit more challenging for someone that's a very beginning farmer is our collateral requirements, specifically with real estate, that we do require down payments that are typically a little larger than what you would see in like a consumer market. So like a little bit bigger than a home loan down payment is pretty typical. And part of the reason that is that, again, that it's a commercial loan, so it's really in that commercial category, and that's in that kind of the requirements for that in that commercial market is a piece of it. And then also, as Regina mentioned, we are a cooperative based structure, so all of our borrowers are the actual owners of American AgCredit. And because of that, we do want to make sure that our credit decisions are very sound, and we're going to be a little less willing to take a lot of risk on some of this, because we want to make sure that we're providing a safe environment for all of the ownership and for the borrowers that already own the cooperative. So in those cases where there may be some issues with down payments and that kind of thing, we may ask for some third party guarantees, either individual guarantees or guarantees from like USDA, from Farm Service Agency, and maybe be able to partner and work with some of those programs. But those are really going to be kind of the limitations typically for someone that's a very beginning farmer, is to make sure that there's an adequate down payment, and to make sure that there is enough income being generated to continue to commit to that repayment schedule.
And we just had another question come in on farming specialty crops that are not commonly grown. Someone's asking if there's a greater focus on the story and painting the picture, and that's definitely true. So while we do farm all agriculture, if there's a riskier type of commodity or it's not something that we see a lot, really comes back down to, we want to make sure that you understand, and if you have a great sense and a great plan of what you're looking to do, as long as it is farming, as long as it's federally legal, then we can definitely explore it. And it comes down to, do you understand? Does it make sense? Are you set up to run that business? And we want to partner with you if that's the case. So there is a greater focus if it's a riskier type of commodity, but as long as you understand the inputs and what's going to come out from that business, it's still something we can finance.
Yeah, and we do, just based on our locations, we do finance quite a few specialty crops. So, we have locations throughout Southern California and throughout Northern California, the areas that in general really do focus on a little more specialization or something that's a little more niche. just because the real estate is generally so expensive that it really doesn't support kind of that traditional commodity farming, the corn and soybeans, that kind of thing um, the farmers are really looking for high value crops. And so we do have a lot of experience working kind of in that specialty crop space. And in general, what we would like to get, part of the loan application is really understanding, what the sales channels are and what's reasonable as far as the sales channel, kind of going back to my, um, winery example, that, it's probably not reasonable that every bottle is going to be sold at $200. And so that same logic, that if you're, let's say, growing like dragon fruit or something that's a little more specialty thing, that, that when you're doing your projections and really trying to understand, kind of come up with this idea or come up with um, the budget of what you think the business is going to generate, that you're not relying on getting the absolute premium price for every piece of fruit, that kind of thing, that it's a reasonable and sustainable, sales channel. So that we're probably going to ask quite a few questions around that. And then kind of following along, I saw there was a question about agritourism. And yes, we do finance people that have that as their business model, that especially in Southern California is pretty common, where smaller farmers are really relying on the premium pricing they can get from that direct to consumer model. And so really what helps paint the picture in that is providing some strong historical results. So if you can show that the business has been open for, a number of weeks or months or years, and that you can paint what that business has been able to generate over that time that it's been open, it really helps provide some of that information on what that reasonable pricing is, because it may be a premium price, it may be higher than what you would typically see on a more commodity based market. But it is helpful to really have that like data to really help provide that test or that question of, is this something that's sustainable? Was this just a fantastic year, or is this something that really is reasonable to expect going forward?
I think we got a couple more questions. So someone just asked, how do we evaluate loan eligibility for a new ag business with no Schedule F file? So we will definitely work with, if you're a new beginning farmer. Again, we might, depending on the loan, the type of loan you're looking at, depending on credit, depending on your specific situation. For us, we do want you to have the intent to farm. And again, depending on your specific loan that you're looking at, we might ask you for a projection if there's no historical income to go off. So it's really case by case. We need to have the intent to farm. And then depending on the loan, we might be asking you for a 3-year projection, or depending on what type of commodity you're looking to start.
So there was another question that came in around kind of that loan classification piece that we had talked about, where it's kind of consumer versus commercial. And this idea of that there's, especially in the world of kind of small farms, there's a lot of properties that sort of are in that gray area, straddling both. And so what we see oftentimes is that if there's someone that wants to buy a piece of property and live on that property and have it be their primary residence, the home, traditional home lenders may shy away from it because the acreage may either be a little bit too large, because a lot of, that traditional home loan is going to have can often have some acreage limitations that, that they don't want the house to be on more than 5 acres or on more than 10 acres, whatever that individual lender's limitation may be. Or oftentimes, if there's any commercial activity happening on the property, the regular home lender is going to shy away from that. And so if you're kind of in that gray area where it's a house in your primary residence and you're planning on living there, so it's sort of this home loan, but there's some commercial activity happening on the property, that's, we can take a look at that as a potential, looking at it as, a farm-based loan. But as I mentioned earlier, it's the commercial market is a different market, and it is going to be, kind of a higher down payment, usually shorter term, usually a little bit higher pricing than what you would see in the home loan market. But there are some lenders that really do specialize in that. And that was the one that Regina mentioned is our lending partner that we work with, is called Rural First. And they really specialize in that niche property of where it is a primary residence and it's someone's house, but they don't have necessarily that same acreage limitation or the same limitation about commercial activity happening on the property. And their loan terms are going to be closer to competing with that consumer market and closer to competing with a home loan term than what you would find in that commercial market.
And then kind of address the question going on in the chat and readdress the question that just came through. So there will be a recording of this and we'll get the slides sent out to you. And then just to kind of loop back and on the original question on how is credit determined for a business when it's a standalone entity, such as an S Corp, newly established, and there's no credit score. So if there's no individual liability on the loan, no credit score to look at, and that's where it kind of came in where Allison was talking about the business plan for the property. So we can look at the business plan. If it's an S Corp, we might be looking at your bylaws to see what your bylaws allow, who signs on behalf of it, how many members are in that S Corp, and kind of what your business plan is, if you have projections going forward. So you can definitely look at it as a standalone entity. The individual piece and the credit score does help, but it's not the, we understand that's not going to be the case for everybody.
I will say though, just to kind of tag on to that a little bit, is that in a situation where it's a new business or kind of in that startup phase, it's pretty unusual for any lender to be excited about lending to just the business, just because it is a riskier position for the lender to be in. And there's not that same historical data that really indicates that that enough cash is being kept in the business and the assets aren't being distributed to the owners to make sure that the loan that there's adequate funding there to support the loan. So oftentimes, if that is the case, that that there is just a business without any sort of individual liability at all, that is going to be the only borrower on the loan, there can be oftentimes more covenants on the loan. And that was, or conditions on the loan. And what that means is basically that there's going to be more monitoring, more reporting generally, just because the lender wants to mitigate the risk, wants to really have that assurance that the business itself is going to keep the funds in the business itself. And so that's why it's really pretty rare for a lot of lenders to be excited about lending to just a business without some sort of individual liability or some sort of support. So I'm not seeing any other questions. Are you anything that we missed, Regina?
Looks like they all got answered unless there's any other stragglers that were typing still.
All right. It seems like we're good to go.
I think so. Well, thank you to everyone for joining us today. We really appreciate your participation and we really appreciate your questions and your engagement. As Regina mentioned, the recording will be available and we'll make sure that the slides do get sent out.
Awesome. Well, thank you so much, Allison and Regina, for such a great presentation, and to all the attendees that engaged with the Q&A and the comments. I feel like this one was the one where the people actually put all the questions in the Q&A, and I really appreciate that. All right. Have a good rest of your day. We'll be here with more workshops.
All right, thank you.